Wolfspeed is currently trading at $32.34, which is a staggering 49.58% increase in today's session. This kind of explosive movement is almost unheard of for a company of this scale, and it immediately begs the question, what on earth is happening? The easy answer, the one you'll read in the headlines, is that the company has successfully completed its financial restructuring and emerged from Chapter 11. That's the expectation, but the reality of what this means for Wolfspeed and for anyone invested in the silicon carbide space is far more nuanced and complex. This isn't just a story about a company getting its financial house in order. It's a narrative about a critical technology at a crossroads, a high-stakes bet on the future of electric vehicles and artificial intelligence, and a testament to the brutal realities of scaling a capital-intensive business. The market is reacting with euphoria today, but the underlying story is one of survival and a long, arduous road ahead. Many investors who have held this stock through its precipitous decline are likely still deep in the red, and this recent surge, while welcome, doesn't erase the deep-seated challenges the company has faced and continues to face. The common belief about Wolfspeed, especially before its financial troubles came to a head, was that it was a can't-miss prospect. It was, and still is, a leader in silicon carbide technology, a material that is vastly superior to traditional silicon for high-power, high-frequency applications. Think of it as the bedrock upon which the next generation of electric vehicles, fast chargers, and even AI data centers will be built. The expectation was that as these industries boomed, Wolfspeed's fortunes would soar. And for a time, they did. But the reality is that building out the manufacturing capacity for this advanced material is an incredibly expensive and difficult endeavor. Wolfspeed embarked on an ambitious expansion plan, most notably with its state-of-the-art 200mm wafer fabrication facility in Mohawk Valley, New York, and plans for another major plant in Germany. These projects, while strategically sound, bled cash at an alarming rate. The company was spending billions to build for a future that wasn't arriving as quickly as anticipated. Softening demand in the electric vehicle market, particularly in Europe, coupled with general economic uncertainty, created a perfect storm. The company's debt ballooned, and it became clear that its capital structure was unsustainable. The Chapter 11 filing in June of 2025, while shocking to some, was the inevitable consequence of this mismatch between ambitious expansion and a delayed payoff. Today's massive stock surge is direct reaction to the news that Wolfspeed has emerged from this restructuring. The company has shed approximately 70% of its total debt, a staggering $4.6 billion, and has significantly reduced its annual cash interest expenses. This is without a doubt a new lease on life. The company now claims to have a self-funded business plan supported by free cash flow generation. This is a critical pivot. It means that Wolfspeed is no longer reliant on the whims of the capital markets to fund its operations and growth. It can, in theory, now leverage its impressive manufacturing footprint to capitalize on the long-term demand for silicon carbide. The market is pricing in this newfound financial stability and the potential for the company to finally execute on its long-held promises. But it's crucial to understand what this restructuring entailed for existing shareholders. The old shares were canceled and replaced with a small fraction of new shares. So while the percentage gain today is enormous, the actual recovery for long-term holders is far less dramatic. The recent trading volume has been immense, which is to be expected with such a significant corporate event. We're seeing a flood of new interest in the stock, as well as a great deal of repositioning from existing institutional holders. It's a chaotic and volatile environment, and it will take some time for the price to find a new, stable level. The institutional landscape is likely to shift dramatically in the coming weeks and months. Many of the institutions that were forced to sell due to the bankruptcy filing may now be looking to reestablish their positions. At the same time, new investors who were wary of the company's debt load may now see an attractive entry point. It's a fluid situation and one that will be fascinating to watch. For those with a Fidelity individual brokerage account or those using platforms like Robinhood or SoFi Invest, the ability to trade fractional shares might be particularly appealing in this volatile environment. Looking at the broader sector, the demand for silicon carbide remains a powerful long-term tailwind. The transition to electric vehicles is still in its early stages, and silicon carbide is a key enabler of longer range, faster charging, and more efficient powertrains. The build-out of 5G infrastructure, the increasing demand for renewable energy, and the explosive growth of AI and data centers all point to a future where silicon carbide plays an increasingly important role. The market is projected to grow at a compound annual growth rate of over 30% for the next several years, reaching a value of over $17 billion by 2029. Wolfspeed, with its vertically integrated 200mm manufacturing capabilities, is theoretically well-positioned to capture a significant share of this market. The company's Mohawk Valley fab is a key asset, and its successful ramp-up will be a critical determinant of Wolfspeed's future success. But the company's plans for a German plant have been delayed, a reflection of the challenging macroeconomic environment and the company's recent financial constraints. This delay, while prudent from a capital management perspective, does open the door for competitors to gain ground in the European market. For those considering an online investment in the semiconductor space, understanding these global dynamics is crucial. Utilizing the research and tools available through platforms like Interactive Brokers can provide a deeper understanding of the competitive landscape. So, what does Wolfspeed actually do? At its core, Wolfspeed is a materials science company. It develops and manufactures silicon carbide and gallium nitride technologies. These are wide bandgap semiconductors, which means they can operate at much higher voltages, temperatures, and frequencies than traditional silicon. This makes them ideal for a wide range of applications, from the inverters in electric vehicles to the power supplies in server farms. The company has a vertically integrated business model, meaning it controls the entire production process from the raw silicon carbide material to the finished power devices and modules. This gives it a significant advantage in terms of quality control and supply chain security. This level of control is something that investors using Schwab Intelligent Portfolios or other robo-advisors might find appealing, as it suggests a more resilient business model. Looking back at past performance, it's clear that Wolfspeed has been a story of immense promise and significant disappointment. The company has consistently reported impressive design wins, with a pipeline of future business that runs into the billions of dollars. However, it has struggled to translate these design wins into profitable revenue. The company's earnings reports have often been a mixed bag, with revenue beats overshadowed by wider-than-expected losses. The capital-intensive nature of its business has been a constant drag on its profitability. The recent restructuring was a necessary, albeit painful, step to address this fundamental issue. The hope is that with a cleaner balance sheet, the company can now focus on operational efficiency and finally achieve sustainable profitability. The future outlook for Wolfspeed is now brighter than it has been in a long time, but it is by no means a guaranteed success story. The company has been given a second chance, but it must now execute flawlessly. The successful ramp-up of the Mohawk Valley fab is paramount. The company needs to demonstrate that it can produce high-quality 200mm wafers at scale and at a competitive cost. Any further delays or operational missteps could be severely punished by the market. Competition in the silicon carbide space is also intensifying. While Wolfspeed has a technological lead, other major semiconductor companies are investing heavily in this area. The company will need to continue to innovate to maintain its competitive edge. Comment below with your thoughts on the long-term viability of Wolfspeed's business model. Do you believe they can fend off the competition and become the dominant player in the silicon carbide market? In terms of potential catalysts, a faster-than-expected recovery in the electric vehicle market would be a significant tailwind. Any new major design wins with leading automotive or industrial companies would also be viewed very positively by the market. On the risk side, a global recession could dampen demand for the company's products. Execution risk remains a major concern, as does the threat of increased competition. The company's ability to generate sustainable free cash flow will be a key metric for investors to watch in the coming quarters. This is where self-investing platforms like Fidelity and SoFi Invest can be invaluable, as they provide the tools to track these key financial metrics. For those who prefer a more hands-off approach, exploring a Fidelity Wealth Management or a SoFi Robo-Advisor service could be a prudent choice. In conclusion, the story of Wolfspeed is a compelling one. full of high-stakes drama and technological innovation. The expectation was that the company would ride the wave of the electric vehicle and renewable energy booms to new heights. But the reality was a near-death experience, brought on by an aggressive expansion strategy that outpaced the market's readiness and the company's financial resources. The successful emergence from bankruptcy marks a new chapter, but it is not the end of the story. The company has a clear balance sheet and a clear path forward, but it must now deliver on its promises. The tension between the immense potential of its technology and the very real challenges of execution will continue to define the narrative for Wolfspeed for the foreseeable future. The market's euphoric reaction today is understandable, but savvy investors will be looking beyond the headlines, closely scrutinizing the company's operational performance and its ability to generate sustainable, profitable growth in a competitive and rapidly evolving market. The road ahead is still long, and while the company has been given a new set of wheels, it still needs to prove that